Hi, welcome to Numeric's video blog. I'm your host, Jim Jockle. This week, China has joined the world's elite currency club, with the IMF announcing that starting in October, that the yuan will join the likes of the dollar and the pound. Joining me today to discuss implications of this announcement, as well as a forward look as to implications for the derivatives market when this takes effect, is our regular FX expert, Udi Sela. Udi, how are you, sir?
Excellent. Thank you, Jim.
So the first question I really want to jump into is really, how does this announcement further legitimize China's currency?
Well, clearly, this is another step in opening the Chinese market for international players and investors in various ways. First of all, basically the announcement means that the Chinese yuan will be a part of the SDR, and that basically means that as it could be a reserve currency for central banks. So clearly, this can augment the demand. It also means that people will start or will be able to start using Chinese yuan as an investment vehicle. You can think, for instance, of international bonds held by international investors denominated in yuan, not necessarily issued in China. You can think of two-way activity. You can think of more volatility. So I think this is actually an exciting development, and this really reflects the increasing weight of China in the international trade. And you can even see that in the SDR, the proportion of Chinese yuan will be higher at the expense of the euro. So basically, we definitely see the impact of the growth of the Chinese market.
So one of the questions is the timing of this announcement, though. Over the last few months, we've seen the devaluation of the yuan as a proactive measure by the Chinese. We've seen a lot of stock market volatility. What insight can you give around this timing?
Well, first of all, we need to take, the devaluation with a pinch of salt. We moved about 2-3%, but that's not really high volatility. Typically, the volatility of the Chinese yuan is around 2%. It went a little bit higher, but not much more. So it's still perhaps 25% of the volatility of the international market. Now, indeed, the timing is very, very interesting. And I think basically what the IMF is trying to do here is to get the Chinese regime to be more, to liberalize the market. Because, again, we saw that, over the years, the claim was that the Chinese yuan was actually undervalued in order to support the Chinese exports. And then now we see that actually the Chinese, when the Chinese does float in the 2% band, and basically what happened was that the yuan actually weakened instead of being overvalued. So in a sense, it enables the Chinese yuan to find its real weight and its real price, the market price, which is not determined by the government. So I think this is really the message that the IMF wanted to deliver, because you cannot say that really the currency has been fully liberalized. So I think they want to encourage the Chinese government there.
So, specifically taking a step and talking a little bit more on the derivative side of things, what can we expect in terms over the next few months? I mean, obviously, we can start seeing different new pairs coming into the markets for FX trading. But, obviously, what is it going to take to get there?
So I think that in the end of the day, even the more the yuan is being allowed to fluctuate, it will be subject to international economic forces. And what we see in general in the world, we see probably two countries, the U.S. and the U.K., where the economic situation enables starting the cycle of rate hiking, while the rest of the world, where we see different, of course, phases in this life cycle, actually the economies are still weak, and the central banks still trying to stimulate activity by lowering the rates. So China definitely is slowing down. So I think it belongs more to this pattern of weakening currencies. So I think it's a very good timing, because on one hand, you could see perhaps central banks starting to invest in the Chinese yuan and generating demand. At the same time, economic forces driving the yuan lower because of the economic cycle. And again, we know that China probably the GDP will grow less than 7%. perhaps more like 6.5%. So I think the bottom line is really volatility, which is always good.
And implications within the region. I mean, obviously, Taiwan, Hong Kong have been gateways to China for years. Is it possible we're going to start seeing outflows of monies from China as compared to, the benefits of liberalization and inflows of cash?
So what I think that the biggest, or at least one of the biggest economical partners of China is Japan. So we can definitely start seeing, the huge Japanese asset managers investing in Chinese-denominated bonds. Perhaps even, Japan will start issuing bonds, which are denominated in yuan, because we know that now a huge part of the government bond sector is already held by the central bank, and they keep on going with the quantitative easing by buying government bonds, and soon they will own the market. So maybe that will be another way to generate more inventory. And if the Chinese yuan will be allowed to weaken, that's probably not great for the Asian exporters, because they will get less local currencies for the sales that they produce in China, and it actually could give China a competitive advantage as opposed to, let's say, Vietnam or other countries in the region. And we see, of course, that the commodities still keep on weakening. So again, that's a reason for the slowdown in the economy.
Well, Udi, I want to thank you so much, and it's something we obviously want to keep our eyes on. I'm sure there'll be some changes in market dynamics over the next few months, especially as we roll into the new year. It'll be interesting to see sensitivity as it relates to if and when the U.S. starts raising its rates. Now that we'll have a little bit more transparency onto the yuan, so definitely more to talk about in the near term. And I want to thank you so much for joining me today, Udi, and sharing your insights. And of course, we want to talk about the topics that you want to talk about, so please follow us along on LinkedIn or on Twitter at NX Analytics. Thank you very much, and thank you very much, Udi.